Hello and welcome. My name is David Vandeveer. I'm the Executive Director of the Passero Center for Financial Markets and Policy here at the McDonough School of Business at Georgetown University. We are going to be talking today about the Silicon Valley Bank failure and the federal government's response to it. And so we're going to have a really kind of casual conversation. We want to find out from Dr. Reena Aggarwal and Dr. Sandeep Dahiya, both professors here at the McDonough School of Business, about what happened. Let's break this down in such a way that it's totally understandable, and also we can talk a little bit about next steps and what's going to be happening going forward. So thank you both for being here today.
Thank you, David.
Thank you.
So I want to start off with just asking just a general question of, can you just give us, the audience, a little bit of background? What happened with SVB, or Silicon Valley Bank? How did we get here?
Yeah, so David, thank you for having this conversation on a very important topic for our economy. And so, what do banks do? Banks take deposits on the one hand, and they give loans on the other hand, right? So, then what was unique about Silicon Valley Bank was it was really catering to the tech community, to Silicon Valley, a lot of startups there. And so it was pretty concentrated in terms of the kinds of clients it had. And this bank was also unique where not only was it not diversified, but a lot of their accounts were from people who were actually these small businesses. And many of these accounts were not insured. They were above $250,000. So as we know, the FDIC insurance typically kicks in only up to $250,000 for an account. And it was very unique with this bank. There were a lot of deposits that were much above the $250,000 limit. Another interesting fact about this bank is how it grew so rapidly. Right? It just literally in 2 years, it went from less than 50 billion to more than 200 billion. So it grew extremely rapidly. It had a very strong lending side, and those the borrowers, they ended up leaving their cash in this bank, and that was part of the deposits. And I think part of the reason that they were able to grow so rapidly was the regulatory rollback that we had in 2018, right? So we used to have a bar of $50 billion, beyond which banks were regulated a lot more and scrutinized a lot more. But with this rollback in 2018, that was changed to $50 billion. So I'm sorry, it was changed from $50 billion to $250 billion. And, that contributed to the growth. It allowed the bank to grow at the pace that it did. At the same time, we were in a very unique environment. It was a very low interest rate environment. The tech sector was doing extremely well, right? The cost of capital was almost zero. So the tech sector was growing a lot, and then things started to change. Interest rates started to go up, and we saw the problems that started happening in the tech sector with the layoffs, and there wasn't money available freely. And all of those came to basically haunt the bank.
Thank you, Reena. You raise an interesting point about how it was one of the main banks for the tech sector. Sandeep, is that really kind of what makes this bank unique, or were there other elements here?
Yes, I would add to the excellent explanation that Reena just provided and build on this unique focus on tech startup. The last 2 years were phenomenal in terms of fundraising. The venture capital was doing very well. Raising money for startups was one of the best. So there was a lot of liquidity. And if you are a small startup, Airbnb is probably too large now, but you need to park that money before you pay it out. And one of the things that came out over the weekend was the startups were worried about how they're going to make their payroll. So, excuse me. So Silicon Valley Bank was the transaction bank for all of these startups. And What is interesting, what makes this very different than 2008-2009 crisis is at the heart of this bank was not fraud or bad loans or poor credit decisions, which were at the heart of 2008 crisis. There were a lot of real estate mortgages that simply weren't going to be repaid. So we had a massive credit failure or credit risk management failure. In the case of Silicon Valley Bank, they had very flush customers who were depositing their money with Silicon Valley Bank. And as Rina pointed out, they nearly quadrupled. This is a very fast growth. Now that money had to go somewhere. And Silicon Valley Bank and a lot of other banks, they parked a lot of that money in US government bonds. Now you would think what could be safer than US government bonds, and they are safe. Unfortunately, while the credit risk was taken care of, the interest rate risk was not taken care of. In the last year, we have had a very rapid increase in interest rates. Many of those bonds became less than what Silicon Valley Bank and some of the other banks paid for. And under normal circumstances, this would be what you would call unrealized losses over multiple years. These things would just bleed through from the balance sheet into the income statement. They will be taken care of. What prompted this run on the bank were rumors, which again, if they weren't concentrated on this just single ecosystem of startups, would probably not have propagated so quickly and so fast. Here, every startup and every VC is connected to each other. So if rumors start flying, they get amplified very, very quickly. The numbers I read was that on Friday, almost $42 billion of deposits were withdrawn, or the request was put in. Now that's remarkable to happen in a single day. So I think that's what I would add to this thing, is that this focus on a single sector probably made the crisis faster.
Yeah, I would just add that the $42 billion that you mentioned, Sandeep, it was withdrawn very quickly. But a step before that, right, was they were trying to sell their whole treasury bond portfolio of $21 billion in one day. And as you mentioned, when interest rates go up, bond values go down. So they had a loss of $2 billion. But it's not so much the loss, but when the market heard about they're trying to sell their whole treasury bond portfolio because there were demands, depositors wanted their money back. And I think that sort of spooked the market.
Right.
They were not able to raise the funds. Therefore, they had to go sell the treasury bonds and take the losses. So, the market is reading all these leaves. And it's also a time when the tech sector, they've got to withdraw cash. They're not doing as well as they were doing a while back. And so they're withdrawing cash. SBF has to sell their whole bond portfolio. And when the market hears about that, then everybody wants to withdraw their money, and the 42 billion comes out very quickly. So all of that was obviously not good news. And on the 2008 crisis, you're right, that was a little bit different. I think of that crisis as very much driven by leverage also, right? Here, the word leverage has not come up. And that it was leverage in the whole ecosystem, whether it was banks, but it was also the Wall Street firms. It was also individual investors, buying houses and flipping. So I think what's happening this time is quite different.
Thank you. Yeah, but it's quite different. But Rina, it raises the next question, which is, shouldn't the regulators, especially knowing that that this bank in particular was kind of the bank for the tech sectors, shouldn't the regulators have seen this coming? Is this a sort of situation that that this should have been played out a little bit on the regulatory side?
Yeah, David, I think there's going to be a lot of sort of soul searching here in terms of how come we didn't get it. And, in 2008, 2009, also the same thing happened. How come the regulators didn't pull the plug? And at that time it was, well, while the music is going on, nobody wants to stop anything. In this case, I'm sure there are going to be questions about what was happening with all the examinations. And when you see something growing so fast and it's not diversified, and there's sort of a mismatch between assets and liabilities, that's sort of Econ 101, Finance 101. So I'm sure there's a lot that the Fed under Michael Bauer's leadership, they're going to be looking at all of these issues.
And so this raises the next question on, and it's probably worthwhile to just take a minute on what the Fed and the FDIC and the Treasury Department, what they actually did. Can we just take a minute and just rewind and let's talk about what happened over the weekend? Obviously, you know, this happened on a Friday. An announcement came out on Sunday night. In the meanwhile, they're looking for bidders and auction. What is kind of, if we could just take a minute to rewind on what the federal government, the regulators actually did, and maybe even what they still have yet to do.
Yeah, so first thing is that they acted very decisively and they acted very quickly. I think based on the lessons learned in the past, we kind of know about what actions to take. And I think that was a really good thing. Before the markets opened in Asia on Monday morning, the Feds had made a joint statement coming out of the Federal Reserve Board, Treasury, and FDIC. The first piece of that was anybody who had a deposit at the bank, even if it was uninsured, it was more than $250,000, you would be covered, right? So that definitely calmed the markets down a lot. And they not only did it for, they also did it for Signature Bank, right? So they did it for both banks. So they sent that message out very clearly. And here it was so important with the Silicon Valley Bank because 90%, more than 90% of the deposits were above that 250,000 limit. Then the second thing they said was, this is not a bailout in terms of taxpayers' money is not being used, but this is going to come out of the Deposit Insurance Fund. This is a fund where all banks contribute to it, right? So all banks contribute. If a failure like this happens, you can use the money. And if the money dries out, then you go back to the banks and you charge them and you fill that coffer up again. So that was the second thing they announced. Another really important thing they announced was additional funding would be available to any bank. You know, if you need funding, you depositors want to withdraw their cash, you can come to us and borrow at pretty much really cheap, get money at really cheap rates. So that was available to all banks. So the Feds did a couple of different things here that helped calm the markets down.
Mm-hmm. And Sandeep, can you just go a little bit into about the auction and how that works and what the plan is on that going forward? We know I think it came out that there were 2 bidders, but they rejected the bids. Can we talk about that for a minute?
So when a business is not able to meet its obligations, it declares bankruptcy. Unlike any other organization, banks in the United States do not declare bankruptcy. FDIC has congressional mandate to take over banks that it considers insolvent. And that's what happened in this case. It's a very classic playbook. Usually FDIC would swoop in over the Friday, would take over the bank, receivership as it is called. And then over the weekend, they would try to sell the bank so that on Monday morning it can reopen and under a new name or under new ownership. Typically, the FDIC tries to do what is called a purchase and assumption agreement. So they would get another healthy bank to purchase the sick target bank, and they would hope that the buyer would assume all the liabilities of the target bank. What this means is for a bank that has a very problematic loan book where a lot of loans have gone bad, you may not succeed in getting a buyer to assume those liabilities. So a lot of the auction then is around what kind of sweetener will FDIC throw in. That is, up to what level the losses would be shared, what could be the upside that can be that the buyer can keep. It was very important for FDIC to obtain what is called systemically important designation for Silicon Valley Bank, because then its room to negotiate expands dramatically. Its ability to offer discounts increases dramatically. Going into the weekend, they did not have that. It was not big enough. It wasn't systemically important enough. At some point, when not enough buyers emerged, I was not in the room. I wish I was fly on the wall. But at that point, probably a decision was taken that to keep to get the wheels of this auction process going, we should declare SVB as a systemically important bank. That also allowed them to also come up with a blanket ability to make good every depositors. So my sense right now is that they are doing moral persuasion as well as coming up with possible ways of sharing the pie so that the bank becomes enticing enough. Clearly, on as-is basis, SVB wasn't drawing a lot of interest. We do not know, there were rumors of one bidder or maybe two bidders or no bidders. We do not know what kind of offer was made to FDIC. Clearly, it would have been very hard if the offer was stingy and there was going to be a lot of losses that might go on to FDIC's deposit insurance or to the taxpayers. But we do not know those details.
Yeah, and I would just add that in all of these decisions, I think that the government made, a big part was so who are these depositors? A lot of businesses who have to meet wages requirements, right? They've got to pay the paychecks, and they needed the cash, right? So if they don't have the cash, they can't pay their employees. So some of that probably went into the thinking of what will be the repercussions. We talk about depositors a lot, and obviously, but obviously the common stockholders, equity holders, and debt holders, there's no bailout for them. There's nothing that's going to help them, right? So those people are definitely going to lose a lot, right? Any equity holder, any debt holder, they're going to lose a lot. Is there anyone who might have gained from this? I can only think of short sellers. So short sellers in this market who had shorted regional bank stocks, and as they saw what was happening here and they shorted other stocks also, they probably made money here. But and the depositors will probably come out all right, but equity holders and debt holders will lose a lot.
Thank you. I want to ask about the systemic designation, because you can see, in order for the federal government to do what they did, they needed that systemic designation in order to bring to bear some of the tools that they did. And you can kind of see it with Silicon Valley Bank, the fact, that so much of the tech industry was tied to it. You can kind of see a logical thread for the systemic designation. But my question is that, and we're going to talk about the 2018 law in just a minute, but, I guess it partly goes to what's the definition of a medium-sized bank, right? Because this was the 16th largest bank in the US. But, at the end of the day, where is there becoming a new precedent on systemic designation, and kind of where is the line going to be? Because one of the arguments for the 2018 law was that, well, these are small and medium-sized banks, and therefore they shouldn't have some of these Dodd-Frank requirements. So if I could just ask both of you about that real quickly.
There's certainly a moral hazard kind of a problem here. So now you've helped these two banks out. Does that mean, do people start thinking that doesn't matter whether I have $250,000 in an account or I have $250 million in an account? It doesn't matter. I'll be protected. People are going to start thinking about that. And this rollback that we had in the rules and regulations to take the limit up to 250 billion from 50 billion. I'm sure there'll be conversations about this. There'll be general conversations about okay, why did we not catch this? What happened? Should we be thinking about these limits in a different way? Are there going to be groups? Right now, it's sort of like 2 tiers. Should there be more than 2 tiers? What does it mean if you're in different tiers? I think there's a lot of work that the regulators will need to do, and then it'll go to Congress to figure out what new laws or modifications are going to be needed.
Yeah, and I would just add to this thing is there's probably plenty of blame to go around for everyone to get, take second helpings. Building on Reena's point is, I think there are just such basic banking 101 issues here that make you gasp. Asset size growth that is in double digits is a warning bell for. There is no credit boom, there's no banking boom that has not ended in disaster. It's like when you grow at, it's a mature industry. If you're growing at 25, 30, 40%, at the minimum, it should raise red flags about like what's going on. And then the maturity mismatch. You have 150 billion plus of deposits on which basically you're saying is these are available on tap. If you want, you can take them anytime. And you turn around and you park that money in long dated assets. This is like they teach it in asset liability management in banking 101, gap analysis. It's one of the most basic immunization strategies that banks are supposed to do. You ladder your liabilities, you ladder your assets so that broadly they are not so badly mismatched. I'm sure there are other banks that hold large bond portfolios on which they have unrealized losses, but they are only a fraction of their deposits. If the depositors were to show up demanding money, they can go through a lot of other stuff before they would have to sort of sell these unrealized and incur these unrealized losses. So my view on this is that perhaps the regulators have some more explanation to do as to how this was not. It was in plain sight. It's just remarkable that no one saw it coming.
Yeah, there was no hedging of risk done here. I think what had happened is we've had such a long time of a low interest rate environment. And I guess their predictions must be that interest rates are not going to go up a huge amount. But with the last 6 months or even a year, we've seen inflation has gone up, interest rates have gone up, the tech sector has had problems. So I'm not understanding why this bank was not shifting its policies and their approach to asset liability management.
Yeah, and just Dina brings up a very, very important point. United States had its last bout of inflation in early 1980s. That's more than 40 years ago. Like a whole generation of leadership has never actually operated in a high inflation environment. A whole generation of regulators haven't operated in high inflation environment. So perhaps it's unfair to say that we didn't see it coming completely, because we do get informed a lot by our own life experiences. The fact that nobody has ever operated in a rapidly increasing interest rate environment, a high inflation environment, probably was a factor too, that it was not seen.
Yeah, well, thank you. So if I could just ask, so bringing this back to 2016 and back to Georgetown University, we had Vice President Joe Biden, then Vice President Joe Biden. He gave a speech that the center hosted at Georgetown University. And in that speech, he linked the repeal of Glass-Steagall to the Great Recession. And now some people are starting to link the 2018 law, to this crisis. And so one question that I wonder is kind of a counterfactual here, but had Dodd-Frank stayed in place and the 2018 law not happened, would some of those requirements that were part of the original Dodd-Frank that did apply to some of these financial institutions before they were rolled back in 2018, could that have helped prevent or maybe even see this coming? Or is this the sort of thing that would have happened anyway? What do you think?
You know, there are certainly some aspects here where you wonder why this didn't get on people's radar screen, right? Like Sandeep mentioned, this tremendous growth, little diversification. Why did this not ring alarm bells for? So it was not an issue of capital ratios that I don't think that would have mattered. So some aspects would not have mattered, but would there have been more scrutiny on the bank if it had fallen in that category? Probably there would have been.
Yeah, and I would add to that is like the one aspect of the Dodd-Frank Act that I can see that could have played in this role is if the original mandate was still there, it would have required the regulators to examine the risk management practices of the bank. So if you are below that threshold, then the regulators don't have to really dig deep into your risk management practices. Clearly, in this case, the risk management did not see this coming. I'm not so convinced that even if the regulators were looking into the risk management, they would have flagged it, largely again because this is a new world for a whole generation. So that I could see is a possible argument that if these regulations were still in place, the risk management would have been scrutinized, and that would have surfaced this issue. But I also have a healthy respect for markets. When we advise regulation, one also has to bear in mind the costs of regulation. We can make banking actually ultra safe. We can require banks to take their deposits and actually just keep the cash in their vaults. That would mean no bank would ever go under. But we don't, because we know that is dead capital. It would just sit there and would not generate any economic activity. So every regulation, it also has a deadweight cost on the economy. And getting that balance right, where the amount of weight it puts on the economic activity is more than offset by the benefit that the regulation generates, is very, very important. And that debate, would go on and would continue. Every administration would like to point to the other administration's policies to assign blame. But yeah, I think that it is going to be a lot of soul searching at regulators and as to how.
Yeah, it's interesting, Sandeep, you mentioned the role of the markets. We're already seeing that, right? The valuations went down so much for several of the regional banks. And
this is what was so fascinating. I did not know this, but the markets are so good at sniffing information out. They piled onto the First Republic Bank. Why? It is the bank with the largest uninsured depositors after Silicon Valley Bank. Among all the banks, like to go and get that information and then just zero in. It's remarkable.
But then people started buying up these undervalued, right?
Yeah.
And prices started going back up. At least today on Tuesday, when we're having this conversation, prices have rebound, and we hear Citadel's hedge fund has taken a 5% stake in one of the regional banks, and so others sort of seeing these as undervalued securities, and so markets certainly have a role to play.
Absolutely.
And it does feel like, even though there's been a lot of activity since Friday, it does feel a little bit early days. You're already starting to see, the Fed investigating and congressional hearings being called. So there's obviously a lot more to come in this space. We wanted to have this conversation now, but I am certain that we're probably going to want to pull you both together in the near future, and maybe a couple more times, because this seems like it's the sort of issue that's going to be ongoing for quite some time.
Absolutely.
Thank you, David.
Thank you.
Thank you, David.